Okay, good morning, everyone, and welcome to the 68th edition of the Coffee Microcaps Morning Meeting. For anybody who's joining us for the first time, my name is Mark Tobin. I'm the founder of Coffee Microcaps, and you're very welcome if this is your first event. And I'd like to extend a warm welcome to all our kind of regular attendees. I'd also like to mention DEM Asset Management, the sponsor of all our virtual events here at Coffee Microcaps, and they help keep this free for investors. So a big thanks to the team at DMX. Quick compliance and disclaimer slide. For anybody joining us for the first time, the companies we have presenting on here pretty much every week are under 300 million in market cap, in revenue and approaching cash flow break even, or indeed already profitable, generally from outside the resources in the biotech sector, what I like to call industrial microcaps, which is kind of a catch-all term for microcap technology, financial services, industrial products, businesses, retailers, anything basically outside resources and biotech. Structured this morning's webinar, we've got 3 companies presenting. Each will have a 30-minute slot, which we'll roughly break down into a 20-minute presentation and a 10-minute Q&A. If you do have any questions, please type them in the Q&A box rather than the chat function in the nav bar. It just makes it easier for me to moderate the questions to our presenters. And please note the webinar is being recorded and it'll be on the Coffee Microcaps YouTube channel first thing tomorrow morning. Follow us. You can get us on all the socials, Twitter, YouTube, as I said, for the recording of this webinar and indeed all the rest in the series, LinkedIn. So this morning, I'm delighted to say we're welcoming back Andreas Kroell from De.mem. This is, I think, Andreas' third or fourth time with us. Then we're going to have Mike Davies, CEO and co-founder of Felix Group Holdings. And then finally, joining us from California, we've got John Hoffman, Chairman and CEO of Pivotal System Corp. So without further ado, I'm going to stop sharing my screen. And Andreas, if you could start sharing yours. Yeah, and yeah, just go to full screen mode. Yeah, there we go, Andreas, you're good to go.
Yeah, all right. Thanks, Mark. Thanks for the introduction and for the opportunity to speak here. So as you mentioned, I've presented a number of times recently on your forum. So I would want to start with a very brief reintroduction to De.mem and our general model. So De.mem stands for decentralized membranes. So we are in decentralized water treatment. We supply mainly containerized water treatment plants deploying innovative membrane technology, which we manufacture ourselves in our plant in Singapore. We like to supply these containerized plants as a service, or ideally even together with a leasing component as a build-on-operate project, because we've strongly moved our business towards generating recurring revenues. So that pretty much takes me to the beginning slide of my presentation. I want to give a quick summary of the key investment highlights, the key points about our business, the things that make our business really special. And then later on during the presentation, I will come back to most of these points in more detail with separate slides. Well, for the very beginning, De.mem is a technology company. So we have over the years developed a strong portfolio around hollow fiber membrane technologies. Originally coming out of Singapore, we benefited from a lot of the R&D work that was done at universities, institutions in Singapore. We have developed technology of different membranes, ultrafiltration, hollow fiber nanofiltration. More recently, we've introduced a graphene oxide-based membrane to the market. These membranes, they vary by pore size. They have different sweet spots. They have different strengths for certain applications. And we make use of them at this stage as the key component, a little bit as the Intel Inside in our containerized water treatment plants, which are often deployed as part of our service or build on operate contracts. As mentioned, moving to number 2 on this list, we have strongly focused on developing recurring revenues around service contracts, around supplying consumables, specialty chemicals. The recurring revenue base that has grown to about 70% of our overall business. This gives our business a very sticky, a very strong and stable basis, which has obviously helped us to get through this COVID situation very, very well. The recurring revenue base, the recurring revenue segments, they have been driving top line growth as well. These segments actually, they grew over proportionately, and they have developed, they have helped the company to build this track record of growth, 12 successive quarters of top line growth now. And we've built the business to about 18 million in total revenues in calendar year 2021, which has taken us to a position where we are certainly approaching EBITDA break even. We are working with a blue chip customer base. Our focus is strongly on industrial customers. We tend to stay away from municipal tenders, which tend to be rather complicated and lengthy and low margin. Our business focuses on building relationships, key accounts with our customers. You can see a few of these logos there. We obviously work with larger multinationals, also with somewhat smaller national companies. However, many of these companies, they operate in multiple locations, they operate multiple sites. And a key part to our business and our expansion strategy is to, well, grow with our customer base from one side to the other. And there are many, many examples where we have successfully started in one side and we were then able to expand that relationship into site number 2 or number 3. The business, obviously, moving further down in this list, has strong ESG components. That's I think very clear around the wastewater and recycling focus when working with this industrial customer base. I'll come back to that on a separate slide a little bit later. We work within a very fragmented market. The competition, there is a lot of small players, mom and dad type companies operating in the decentralized water treatment space, which are focusing on technical niches, product niches or whatsoever, which are very limited in technical and financial capabilities. And that leaves us with a clear opportunity to consolidate that market, not necessarily by acquisition, but by, well, putting a business model together, which is a little bit smarter than what our competitors do, and by making use of our, well, technological advantage. Well, this growth model, that's complemented, that's completed by an opportunistic acquisition strategy. We've very successfully made a number of small bolt-on acquisitions, which were pretty low risk in terms of capital involved, but helped to grow the business, in particular the recurring revenue base, tremendously. And I will give a few more numbers towards the end of the presentation. The following slide gives a bit more a general overview of how our business operates. These are the 4 segments of our business. It obviously starts with the water treatment equipment, the membrane systems, which are often containerized. And as part of these systems, as mentioned, we usually deploy our proprietary hollow fiber membrane technology as the key component to give us that competitive edge which our peers obviously can't have. Then towards the right, the services, the specialty chemicals, the pump services, small water treatment equipment segments, those are the recurring revenue segments of our business. So these segments, they make up about 70 to 80% of our revenues. As mentioned, the systems, the equipment, ideally, we want to provide it to the customer either together with a service contract if the customer wants to own the equipment, or we can offer a build on operate model if the customer is interested in the full and hassle-free service. And these are important segments because they lead to very, very stable and sticky relationships to customers. And then beyond the equipment, it was important to us to benefit from the whole commercial opportunity by being able to offer something like a one-stop shop product supply around chemicals, consumables, and so on that are required during the ongoing operations of water treatment plants. And importantly, through the acquisition of the CAPIC subsidiary in Perth, which we completed in April 2021, we were able to bring additional IP into De.mem around specialty, non-commoditized chemicals, really very, very high margin products, which we now manufacture out of our own workshop, out of our own blending facility in Perth. As mentioned, there is an obvious ESG impact of our business. There is different aspects which we cover. The industrial wastewater treatment aspect, I think that's very clear. So we have about 15 larger build on operate and service contracts over operations. Under operations at the moment, we treat like a tremendous amount of water to regulatory discharge standards usually under supervision of the environmental authorities. So we help our clients to fulfill like an environmental mission. Looking at our technologies, hollow fiber membrane technology is generally low in power consumption. It requires little harmful chemicals and little bulk chemicals. Only, as mentioned, specialty chemicals, which are typically high in value, but low in volumes required. Our nanofiltration membrane technology in particular, that's a membrane which delivers very high quality treated water. It works under low operating pressure, which means low power consumption, which obviously helps clients a lot to meet carbon reduction requirements and so on. So it fits very well into the current environment. And lastly, our new membrane technology around the graphene oxide membrane, and I'll come to that one just in a few seconds. This one is targeting the domestic filtration, household filtration market as its initial commercial application. That's a market where plastic bottles are still kind of the state of the art, with only a fraction of those being recycled in countries like Australia. And with this product that is aiming for this domestic tap water filtration market, we're certainly helping tremendously to reduce plastic waste. So the next slide then provides a few more details on this new technology. We have presented this membrane technology in August 2021. So it's still a pretty new technology. It's very unique within the industry. What we are doing there is we are actually taking a standard polymer ultrafiltration membrane, and we are enhancing this membrane by the addition of graphene oxide nanoparticles. So the GO, graphene oxide nanoparticles, they are mixed into the polymer chemistry, and this helps to tremendously improve on the well, filtration characteristics, in particular the water flux. The water can flow more efficiently through that membrane. The same amount of membrane can treat about 20 to 40% more water, or alternatively, the same amount of water can be treated with a much smaller cartridge. And that obviously leads to the application household or under the kitchen sink water filtration. That's an application where space and size of the actual device is very important. So we can reduce the size of the cartridge and the filtration system. And in that context, we are talking to distribution partners, and we have initiated a process for American NSF certification. The NSF is the American regulator which approves all drinking water related products. And we are expecting results towards the end of the ongoing calendar year. The next slide gives a few examples of existing build on operate deployments. I want to move to the right of that slide right away. That's a more recently announced contract. It was announced in September 2021. Customer is a large Australian corporate from the agricultural sector. They operate multiple sites in Australia. This contract covers the wastewater treatment for the first site that we're working on with them. It's their largest site actually at this stage. It's a $2 million contract over 5 years, so it's about $400,000 per year, deploying our membrane technology, our ultrafiltration technology as the key process, and our chemicals, which are well manufactured in our plant in Perth. So it also gives an example of how well our products work together in terms of cross-selling. And importantly, as we speak, this plant, it's 2 containers. It's almost operational. It's in the final stages of commissioning. We expect operations to start within the next few days. And that's obviously important as from the commissioning date, this plant will generate revenues and margins and help to improve our results further towards the second half of the year. We did announce, just want to mention that briefly, we did announce a second build on operate project in early December 2021. The customer there is the Selwyn Snow Resort. And this BOO project, it's also in the very final stages of commissioning. We expect operations there to start in around June, so in about a month from today. And so this second contract will also come alive and will also support our numbers, our financials in the upcoming quarters. A few words on our acquisition strategy, in particular in the context of the more recent acquisition of the Stefco seals and pumps business in Melbourne. So we have made 4 acquisitions now in total since 2019. Stefco obviously very recently in April 2022. It's truly bolt-on acquisitions with the value or the money spent for each acquisition being a very small percentage of the company's market cap. Taking the largest one, maybe in a bit more detail, which is the Capic business out of Perth, which manufactures our specialty chemicals. This acquisition, it was announced, it was legally completed in early April 2021, so about 1 year ago. The idea there was to sell our wider product range, our innovative membrane technology into Capic's customer base. At the same time, the other way around, to take Capic's specialty chemicals, which directly relate to membrane-based water treatment plants, and sell them into our existing customer base on the east coast of Australia. The business has grown from about 3.3 million in pre-acquisition revenues to 4.8 million in revenues in the 12 months ended on the 31st March 2022, which is about a 45% growth rate. So a very successful, definitely a very successful acquisition for us, where the cross-selling strategy and this tech rollout strategy has worked out very well. With Stefco, we certainly have very similar things on mind. We paid about 4.5 times EBITDA for Stefco, a business profitable with about $330,000 in EBITDA per annum prior to the acquisition, which was completed on the 1st April 2022. And we are very confident. I'm personally very confident it's the same value proposition, strong industrial customer base. I'm very confident that in a year or two, I will be able to present similar charts in terms of revenue growth about this acquisition as well. That takes me to the last two slides of the presentation around the financials of De.mem. Quick summary of the calendar year 2021 financials. As mentioned, very decent revenue growth even during the COVID phase, because the recurring revenue segments that grew up to 70% of total revenues, they grew over proportionately, and they've been driving the overall top line growth of the company. We were seeing strong momentum with now 12 consecutive quarters of growth in cash receipts. Importantly, also the recurring revenue segments, the specialty chemicals, the service contracts, BOO contracts in particular, that tend to be somewhat above the average gross margin of our business. So this has been driving the gross margins from about 19% back in calendar year 17 to 34% in the previous calendar year 2021. And we definitely expect to see that trend continue a little bit further, as we still expect to see this percentage of recurring revenues grow a little bit further up of the north of the 70%. Looking at the EBITDA and the profitability of the business, the underlying EBITDA, which adjusts the EBITDA as per the P&L for truly one-off factors, such as business acquisition cost. For example, for the CAPIC acquisition in 2021, we paid a substantial amount of stamp duty, which is definitely a one-off. We have seen like an underlying adjusted EBITDA of minus 2.2 million in calendar year 21. This splits up in about 1 million investment into the Singapore activities. You would find that number in the segment reporting in the annual report, which is largely going into membrane research and development. And the biggest chunk of the remainder, that's an investment into a build-up of the sales and marketing organization, which obviously has been driving this top-line growth that we've seen at De.mem. The last slide, very few quick comments on the March quarterly report. So the March quarter was, I think, very successful for us, a very strong start into the calendar year 2022. We've seen about 49% cash receipts growth relative to the prior corresponding period, the March quarter 2021, which is remarkable, I think, because typically the March quarter is a little bit slower for us because customers are traditionally on leave in the month of January. Again, the recurring revenues, the recurring revenue segments have been driving growth. We've seen about 78% of the cash receipts coming out of the recurring revenue segments. We finished the quarter with a strong balance sheet, about 6.7 million in cash and term deposits, which leaves us well funded for achieving further growth. We did communicate a guidance for the recurring cash receipts because obviously we got a strong visibility. This will be complemented by the projects receipts, which are a little bit harder to forecast, but we will most likely provide a number later, which takes us to the total cash receipts expected for the calendar year 2022. And this altogether has taken us to a point where we are strongly moving towards profitability, EBITDA profitability now being in the focus. And we have communicated as part of our March quarterly that we are targeting to see a quarterly EBITDA break even. The first quarters where the EBITDA will be should be in the positive by the first half of the calendar year 2023. That takes me to the end of my presentation. Most happy to take questions now, and obviously also by email through the investor@De.mem email address.
Thanks, Andreas. Just a couple of quick ones from me. On the acquisitions, I know part of the acquisition strategy was to, give you that national footprint in Australia, which is pretty much there now. Future acquisitions, is it a plan to, think about small acquisitions to enter new markets, be that, industry verticals in Australia or perhaps internationally, or would it be more getting access to a particular niche technology? You talk about the mums and dads, a niche technology that you can slot into the wider one-stop shop De.mem offering.
Yeah, Mark, I think looking at the technology and product portfolio, we are quite well positioned with De.mem now. So we have our range of membrane technology, which actually covers a lot of interesting and high value add applications. We got our specialty chemicals, which are extremely high margin products. So I think there we are very well positioned. So acquisitions for us, they really help to, accelerate growth in a sense that we have a chance to move quicker into an existing customer base. Like closing a first deal with an industrial B2B customer, sometimes it can take a little while, and there these small bolt-on acquisitions have really tremendously helped to accelerate things. So that would be the motivation behind. That being said, I think we're quite well positioned at the moment in Australia. We have covered the country pretty much nationally now. We have a lot of opportunity for organic growth. So we're not looking for acquisitions at the moment. We have plenty of opportunities there to grow the business as it stands. And it's something on an opportunistic basis, Mark, that we might consider.
And then just on the home water filtration new product, are you also planning to launch that in Australia, or is it primarily a product for the US market that's going to be the focus of the launch?
Yeah, depending on how well discussions with potential partners go, the first market for us would probably be the North American market. That's a large and interesting market, and obviously we're at the moment going through this NSF American regulatory process. Australia is quite an interesting market as well. It's pretty large markets also in terms of dollars. Australia, however, requires a separate regulatory approval, which is based on achieving the prior American NSF approval. So Australia would logically, automatically have to be the next step. But around these product lines, there's obviously plenty of opportunity also in Asian countries where this domestic water filtration is a massive market because the tap water quality is not very strong. So there is plenty of opportunities in other countries as well.
Andreas, we're going to have to leave it there because we're just up on time, and I know our next presenter's on a bit of a tight schedule. So thank you for coming back and giving us an update on all things De.mem.
Thank you very much. Thanks, Mark.
Okay, if you could stop sharing your screen, please. And then Mike, if you want to start sharing yours. I can see it coming up now. Yeah, I can see your slides now, Mike. You're good to go, mate.
Thank you, Mark. Hello, everyone, and thanks for joining. Great to be presenting to you today. My name is Mike Davis. I'm CEO of Felix Group Holdings. Our code is FLX. It's a particularly exciting time for the company. We've just completed a capital raise that included a cornerstone investment from Innate, a strategic partner of ours and a global construction software leader. We'll talk a little bit more later in the presentation around what that means for Felix and what the opportunity looks like. But just conscious that some people may not be as familiar with the story. So we'll spin through a little bit of a 101 to give you some background and context on who we are and what we're doing before we move through to the strategic investment and that opportunity. We are at Felix, we're a construction software platform. We have an enterprise SaaS solution as well as a marketplace platform, and we connect the construction industry here in Australia, particularly head contractors. So the big names such as CIMIC Group, CPB contractors, McConnell Dow that you may know, those tier one type contractors with all of their third-party vendors and subcontractors on a project. But just by way of, I guess, macro picture and lens, what we're seeing at the moment is a real perfect storm of converging issues in the construction industry, which are really playing into the hand of Felix. It's our federal infrastructure pipeline is at historic levels and being leveraged, used by the government to drive the economy post-COVID. So the Land Transport Infrastructure Program, as it's known, is in excess of $110 billion of projects waiting to come online. But what they're calling it out in the field is the infrastructure boom that's impossible to make a dollar of profit out of. And that's being driven by razor-thin margins and a culture in construction of bidding to the lowest price and to the bottom. The cost of operating is significantly increasing. ESG targets are rapidly increasing year on year. Third-party compliance, modern legislative acts such as the Modern Slavery Act coming in. So just the cost of doing business for construction organisations and the price to play is significantly rising year on year. And we've got an industry like construction that's traditionally a laggard in terms of their IT spend. So all of those converging forces coming together. I mean, if you followed the news recently, you would have seen, unfortunately, leading names like ProBuild and Condev going under. And this is the unfortunate sort of result of all of those converging forces and razor-thin margins that are out there in place. So Felix is a solution that connects those contractors to those vendors and makes it much more efficient for them to manage and engage with each other. So you can see there in the middle where the platform and the marketplace, and we also integrate with for contractors their other core business applications such as their ERP, that might be SAP or Oracle, their document management solution, which could be something like Procore or Aconex or Innate's document module. Now we've focused on building out a truly enterprise solution that's turnkey for leading tier one contractors to be able to move their entire gamut of processes right throughout the way that they manage their vendors and procurement onto the Felix platform. Traditionally in construction, these processes have very much been managed by projects, and projects work as silos and run their own systems and platforms and processes. And those market forces that I've been telling you, just told you about in the operating landscape are really forcing the hand of these leading organisations to centralise and standardise the way that they manage these processes right across the enterprise and have visibility, transparency, and process governance around the way that they procure trades and subcontracts, and be able to manage supply chain risk effectively. Where an environment where one bad trade on a major project can literally sink a tier one and have ripple effects through industry. It's that management of risk across supply chain, which is such a hot topic and area of focus at the moment for construction. So we've built a truly enterprise procurement solution that's built for construction. What we've solved for is either a sea of manual processes, spreadsheets, paper-based forms, everyone working in silos, or construction organisations being forced to use a more general procurement platform such as SAP's Ariba that the project teams might colloquially call the pens and pencils type platform, but not suited for, say, procuring 100 trade packages on $1 billion infrastructure project. So you can see here with the leading names that we've been able to acquire and continue to accelerate bringing onto the platform. Significant amount of due diligence and selection screening processes from these types of names to land on Felix as their partner to manage mission critical business processes right throughout the organisation. Like a number of enterprise SaaS solutions, the way that we've built the platform is in a modular sense. So customers can choose to either license one or a few or all of the modules that you can see on the screen. And our core focus on contractors as our customer, they pay us an average, an enterprise annual SaaS license fee. We normally typically sell multi-year, 3-year contracts, and you can see there the average of around $68,000 ARR. That might be, say, $20,000 to $30,000 at the low end, and up to about $700,000 per year. Our largest customers paying us. Like I illustrated to date, we really transform that entire procurement lifecycle. When we think about the construction project lifecycle from cradle to grave, there's a lot of different phases of the project, right from planning and BIM and design and estimating and tendering to win jobs. And if a contract's awarded, you go into the operational and delivery phase and project controls. So what we've really carved out for Felix is that focus during the delivery phase of a project, procurement of trades, and the way that organisations manage the relationships with all of their third-party vendors who actually build and deliver the capital works projects. What we've seen, if you zoom out from construction over the past 30 years, is that head contractors really don't perform any of the works themselves these days. They typically contract consultants and suppliers. They buy the raw materials from suppliers and engage subcontractors to deliver the work. So what Felix provides them is a platform that gives them visibility and real-time data on who they're working with, and it provides the subcontractors with a portal to manage all of that bidding information and their insurances and pre-qualification data in real time. If you know anything about sort of technology and marketplace platforms, you'll understand the power of network effects to build a truly defensible and valuable, sustainable, valuable asset for investors. So investors love network effects because they are so defensible and create compelling monetization opportunities. The trade-off is that they can be really costly to build, and that chicken and egg conundrum of being able to scale the supply and the demand in equilibrium. Part of the secret sauce at Felix is that as we've built a turnkey solution for the tier 1 style contractors and large construction organisations, what they in effect do is then onboard their entire supply chain of vendors across the business and all projects. An email will go out often from their CEO saying that we're now modernising and digitising the way that we engage with our third-party vendors. You'll need to create a free account in Felix if you don't already have one, pre-qualify to our organisation, and then you'll continue to receive RFQs and tenders, etc. So because the scale of those tier one style contractors, they can often have thousands, it could be 5,000 or 10,000 vendors that they've worked with in the past few years. It's their mandated usage of Felix to their third-party vendors, which is creating such scale for us in our marketplace on the vendor side at little or no acquisition cost to Felix. So here's our plan on the page. Really, it's the focus on growing the number of contractors that are using Felix, which is really the growth engine for our business. It's scaling the ARR, the annual recurring revenues that we've got, because we sell them the healthy enterprise SaaS license fees. They onboard and roll out Felix across their entire enterprise and projects. And then, as we said, onboard their third-party vendors as well, which drives scale in the marketplace and what we think is a really compelling opportunity to downstream monetize the vendor side of the marketplace at scale. So you can see here, we had a COVID impacted year in FY21, but rebounding strongly out of that this year. The pipeline is really healthy and moving well, and we've got some significant well-known household names moving through that, which we'll be excited to hopefully share some results on in the near future. Then moving into a really healthy addressable market, even just locally in ANZ, and we'll talk, as I said, a bit more about the Innate partnership, but that's opening up international regions for us now as well, which is super exciting. We've broken down our strategic plan into 3 distinct phases. Phase 1 was all about investing in the technology platform that's going to be able to churn out those really high margin enterprise SaaS contractors. We've had the validation from our major contractor customers and tier 1 names and driven that initial marketplace growth. We're into phase 2, which is all about expanding the platform with further modules that we're working on. We've ticked off our phase 2 target of 60,000 vendors in the marketplace, and we'll be continuing to grow and scale into phase 3, which then becomes about turning on the tap of monetization on the vendor side of the marketplace with some of those modules that we're building. So I'm just going to, this is the deck that we just released to the market for the capital raise. So I'm just going to scroll back up to the out of order from a linear sense and take us now into the Innate partnership and the capital raise that we've just completed, cornerstoned, as I said, by Innate. So what I'll give you first is just a little bit of context as to the scale and gravity of who Innate are and their parent company, Kiewit. So Kiewit Corporation is one of the US's largest, I believe, 3 largest contractors, construction contractors by size, as you can see, top half of the Fortune 500 list there. And for years, they had a technology division internally, and in about 2010, made some acquisitions there and spun it out into its own standalone subsidiary, Innate. And over the past 10 years, Innate has been very acquisitive and grown quickly into becoming a global construction software leader. So they have a product suite which is quite broad, similar to the likes of Oracle and Autodesk and Procore, if you know those names, a truly sort of end-to-end solution. So significant player with global blue chip customer base and over 850 enterprise customers. We were really fortuitous that a very well-known household tier 1 construction name in Australia went out to market early last year for a broad end-to-end construction management solution. And stack ranked at the top of their priorities was vendor management and procurement that Felix solves for. And the messaging to Innate from this customer was, if you want to be in a position to win this contract, you'll need to partner up with a platform like Felix, because vendor management and procurement is our highest priority, but it's also looks like a clear gap in your product suite. So we partnered up on the bid and remain going through that process. We're down to the final 2 on that and hopeful of a positive outcome there that we can share in the near future with the market. But I guess the broader context being that Innate's global head office in Phoenix, Arizona, quickly caught wind of the bid and immediately saw a broader strategic opportunity to get partnered up in a strategic sense with Felix, integrate the platforms to a deep level such that data flows and data points between each for customers, if you used Felix and Innate, would really drive what we call a compelling 1 + 1 = 3 outcome for our customers. And also then roll out Felix across their global customer base, not only in the APAC region where we're currently focused, but larger international markets such as US, Canada, UK, EU, Scandinavia. So that's super exciting, and we worked away in the background and executed a 3-year agreement in February. Now, we're very excited with the progress, how that partnership's been progressing to date. It obviously offers Felix a significant step change opportunity in terms of growth and customer acquisition. We've spent the past number of years and invested significant capital in our enterprise solution to be at its exciting inflection point where we can really now put the foot down and drive top line growth while keeping our fixed cost base relatively stable. Before we even sort of hit the market with our sort of go-to-market strategies with Innate, we've already had, in addition to the tier 1 name that brought us together that I told you about, a further 2 advanced pipeline opportunities materialise, one with 2 major Victorian government bodies that's in very significant advanced stages, and another with a leading Canadian contractor. But just in terms of broad progress, we've our APAC teams have joined up, and they're going after those 234 names that you can see there. They've drawn up a list of 30 or so low-hanging fruit, and the rubber's really hitting the road now on accelerating into those. Or further to that, we've now been brought into some significant opportunities in the US through Innate, into Scandinavian regions as well, into advanced stage opportunities. So if we think about our largest customer here in CIMIC Group, just the time and money that was spent acquiring almost over a number of years that to win that customer, so that the capital and time to be able to win significant market leading cornerstone contracts in new regions, and now to have through Innate that ability for them to bring us in and almost parachute us into those types of opportunities at the very late stages. It's just a significant sort of catalyst moment for Felix now to be able to have that turnkey capital light entry strategy into these markets that we're talking about. They're a significant resource for us in terms of infrastructure and team in these new regions as well. And the partnership is so strong to the point where Innate have offered Felix at no cost to us the ability to leverage their implementation and support resources on these deals in new regions, our first few key contract wins, until we're able to sort of stand those up and have success, and then look to invest some of our own resources in regions. So to, I guess, reinforce my point, extremely capital light strategy and significant market access opportunity in larger geographies now. So I think for what we've been focused on is building a technology solution that's globally best in class. Our customer focus to date has been in Australia and New Zealand, and now we're just at that exciting point where, as a SaaS platform, we're going to go onto the global stage and rapidly build out a global customer base. Very quickly, because I know we're sort of heading towards time for questions, but just an extract here of some of our quarterly performance highlights. You can see now that we're up to 4.6 million of group ARR. The focus clearly is on continuing to ramp and scale that number. We had a really exciting quarter in terms of the quality of names that we were able to bring in some adjacent sectors that we're targeting. Our core DNA is in sort of civil infrastructure and civil contractors, but what we've found is the applicability of Felix into related sectors that have a related use case, such as mining services, Real estate owners, so you can see GPT Group, a really large listed REIT asset owner and manager there, provides us access into that. Boomer is the spin-off of Downer's mining division, and Altrad are a significant global leader in industrial services. I mentioned that the number of vendors on the platform has ticked over our phase 2 target of 60,000 there. And that contractor ARR retention rate of 106% that you can see there, that's well above benchmark for enterprise SaaS. And we believe heading towards global best in class there. So that's a real area of focus for us too. Mark, I think that's about landed on my 20 minutes of overview. So I'll hand back to you if there are any questions.
Yeah, we've got one from the audience already. Is it mostly in-house processes that potential clients would use instead of Felix, or are there similar offerings you compete with? So I think, yeah, maybe just tease out the competitor landscape in terms of, are you up against the internal process or system they might have cobbled together, or who are the other main players that you come up against on bids?
Yeah, sure, Mark. It's often a patchwork when we think about the size of these organisations, and I guess the broad spectrum of processes that Felix covers off on. It can be a patchwork of some manual internal processes. They might have built some little apps and widgets that cover parts. There may be point solutions that fill particular gaps. So in terms of a construction, what we've built for construction, Felix really is a comprehensive end-to-end solution. We integrate with a lot of solutions, like I said. So typically for a large customer, we'll integrate with their ERP, which is their sort of core financial platform, and Felix becomes the source of truth for all of their third-party vendor information and passes that data along, as well as their document management systems, like I said, for projects that manage all of the documents on a project. Probably the space that we're really moving into now, and driven largely by names like GPT and others, is some of the compliance data platforms that are out there, like Reuters, Thomson, and Bureau van Dijk, Creditor Watch, these sorts of things that perform financial solvency checks or director checks on organisations that they may be looking to work with. So integrating with those types of solutions. So within the Felix workflows, when you're looking at a vendor and doing DD before perhaps engaging them on the job, you can see that they've got the tick for each of those services, and all of that visibility at the hands of the people that are looking to make quick decisions on projects. So it all boils down to, have we got real-time informed business decision making in our hands when we need it, to be able to sort of reduce risk on those decisions.
Then another one, people are probably very familiar with Aconex from a few years ago before it got taken over. The question is, can you maybe describe the difference, or maybe do a little compare and contrast to, the Aconex business from what people would know of that when it was listed?
Yeah, absolutely, Mark. I think it's a great story to reference. Aconex was founded by Lee Jasper and Rob Philpott. Rob Philpott is now on our board, which I'll talk about in a second. And they grew Aconex over 20 years to be a global leader in what they do, and ultimately acquired by Oracle for what was then a record 1.7 billion in 2017. So they're focused on the actual sharing and collaboration of project documents and design documents, and the updates to those are automatically synchronized across all project participants. So really that document management feature. Felix has some document management capability, but for most sort of serious players, we would integrate with their existing document management solution, and there are a few leaders in that space. Rob, the co-founder of Aconex, like I said, he tells a great story that when they first started Aconex, it stood for Australian Construction Exchange, and they were out to solve the procurement problem in construction. He and Lee were, but it was sort of 1999 and dial-up modem days, and they quickly realised that they didn't think the internet or their customers were quite ready for it. So they pivoted into document management to get the cash flows going, and the rest was history. They took over the world. So once he'd been acquired, they'd been acquired by Oracle, and he'd gone through that journey. He saw sort of joining Felix and helping management go through that same journey as an opportunity to go back and solve what was their sort of day one problem for Aconex.
Okay, cool. Then another question, and it's one I think is on a lot of people's minds this Appendix 4C season. How do you think about the balance between, obviously investing for growth and the opportunities in the pipeline versus, trying to get to cash flow break even and self-funding it, something that's kind of, I guess, a market theme or top of people's minds at the minute?
Yeah, absolutely. I think like everyone, we need to be really prudent with our decision making and investing wisely for growth at the moment. We've raised just finished a capital raise of $6.4 million, cornerstoned by Innate and supported by our existing really high quality institutional funds on the register, and that is about having adequate additional resources to be able to accelerate into the Innate opportunity across both sort of product and engineering, as well as sales and marketing resources, particularly in the new regions that we'll be moving into. I think that the really great thing about Innate, like I've mentioned, is the immediate access it provides to significant scale contracts for us and organisations, and obviously those types of contracts bring cash flow, immediate cash flow boost, as well as our customers pay annually up front with those. So we'll continue to we believe we've raised enough cash to accelerate into the Innate opportunity, really put some early stage success and footholds into those larger international markets, and be able to do so really comfortably with what we've got on the balance sheet now and what the immediate sort of term looks like in terms of opportunities.
Then a final question from me. In terms of the modules that you have now, and I know you mentioned you've got some others in train with the dev team, how many modules would they I'm not sure if John Holland are a customer, but somebody like of that size, how many on average do they take? And has that been growing over time? So somebody might just take the vendor management one, but then they're taking some of the others as they kind of get more familiar with the system. I'm just trying to get I'm a big believer in kind of selling more to the customer once you have it.
Absolutely, Mark. And if you look at the cross section of our customer base, most of them we've sold off the back of our vendor management and sourcing modules. So procurement schedule was released recently, and contracts is what we're currently building out to be a fully fledged contract management module rather than the storage repository that it just is. So we think that really large customers, like you mentioned, like likes of John Holland tier ones, will take the full suite. But what we're really pleased about is the number of our existing customer base who are expanding their accounts, either just through organic usage and rolling out to more projects and licensing more seats on Felix, or adding modules to it becomes obvious once you've solved vendor management, the advantages that you get from plugging in further downstream modules that connect into that centralized vendor base. So that revenue retention number of 106% that I spoke to about, that is really a reflective source of truth about what you're saying, of the importance of selling more to the customers you've got as a driver for growth, because that nets out your churn over the past 12 months versus the expansion of the customer base that you had 12 months ago.
And then if I can get one other quick one in here, in terms of the, I guess, project owners, whether that's state, federal governments, somebody like GPT Group or whatever, to what extent are they doing or could they do, where they say, if you're going to be the head contractor on this job, you have to have, might be Felix, but they can specify more broadly, a vendor management system, a procurement contract system, in place where they're, not just leaving it up to the contractor, they're kind of pushing it onto the head contractor piece in the first place.
Brilliant question, and something that's really commonplace for the document management platforms that we've spoken about. So head contractors will often use a few different ones because it can be client driven. If you're going to win this project, you'll be using innate document module. So we believe that's a real area to go after, and we've got a strong industry voice at the moment around this, around pushing clients and owners as they take on more shared risk contracts, and they stipulate in their contracts that you must meet ESG targets like 50% local supply, 4% Indigenous owned contractors, 1% female participation on construction sites. It's don't just tell me that you're going to do it, show me the systems that you're going to use to be able to achieve those targets. So we think that's a real area of growth for us and expansion, because it's obviously the owners and the clients that they've got the most leverage in terms of driving what systems are going to be used, because they're ultimately the ones paying the bill. So yeah, we think that's a really exciting area.
Mike, I'm going to let you go because I know you're actually joining us from another conference. So thank you very much for taking the time out of your presentation schedule to present to us this morning.
Thanks for having me, Mark, and thanks to everyone for joining.
And if you could stop sharing your screen, and I know we have John Hoffman with us waiting patiently. I'm just going to share John's slides now, and let me just go to the start. Okay, John, I will move on through the slides as directed by you.
Okay, thank you, Mark. Can you hear me?
I can hear you. Your audio is sounding perfect.
Thank you. First, again, this is John. I'm the chairman and CEO of Pivotal Systems, and I'm broadcasting today from Fremont, California, which is in the heart of Silicon Valley. It is a real pleasure to speak to everyone this morning and try to take you with an overview of Pivotal. I think some folks might have some ideas. I think others are learning about the company for the first time. I'll also give you a little bit of an introduction into this global electronics industry, which is very, very large and growing very, very fast. And I know of over 30 projects that are greater than $7 billion that are in construction right now. So Felix probably should start looking at semiconductor fabs, because they're springing up all over the world. And there's a lot of turbulence and problems in getting these things online based on the number of people and dollars involved. If we go to slide 2, Mark, this is just the standard disclaimer. We can go right on through that. And I'll go to slide 3 to give folks just a snapshot of the company, the relative codes on the ASX if you have an interest. Also, I'd point you towards our website at www.pivotalsys.com. We do have an investor tab. We recently released our 2021 results, and that entire investor presentation is there with a lot of detail and granularity that people may need about the industry and our customer absorption rate and things like that. So that's there. And also I'd advise that Dr. Thomas Duthie is in Australia as our investor relations head, and you can reach Dr. Tom at any time, as well as Pivotal Systems headquarters at any time. Let's go to the next one. So this is just a quick overview of the semiconductor industry that Pivotal participates in. If we go to the upper left photo, that's a current factory that's in Seoul, Korea, run by Samsung Electronics. And if you look at the kind of the fine print there, you can see like little cars in the middle bottom of that. So the size of these factories are absolutely massive. They generally take a year to 18 months in construction before the semiconductor equipment gets moved in. And then after the equipment comes in, it generally comes in waves because they'll bring on a wave of production in order to handle a given number of wafer starts per month. The typical factory right now is somewhere between $7 and $14 billion in construction, and those are in US dollars. I'll mention the quantum of the amount of fabs in production later on. The bottom left shows a typical aisle inside a clean room in one of these factories. The thing that you'll notice is there's just not a lot of people. There's a track system in the ceiling in the center that's moving these wafers around the factory, all managed by the factory computer systems. And there's about 450 process tools when these factories are fully facilitized and up online, doing somewhere around 150,000 wafer starts a month. A typical wafer can hold, a couple of hundred of microprocessors or a couple of thousand NAND flash chips or DRAM chips. So the volume of production going through these factories, 7x24, 365, just never stops. On the upper right side, it's a picture of one of those process tools. So if you look at the bottom left, you see a number of them in a line, but what one of them typically looks like is on the top right. That's an etch tool from Tokyo Electron. That is a 6-chamber tool. There's 3 there, as you can see on the left side. The front of the tool are the wafer load locks where the various transports for the wafers actually load in. There's 3 other production chambers on the other side, so a total of 6 process chambers. And then finally on the bottom, there's a gas box. Each one of those chambers has a gas box where there's somewhere on the magnitude of 12 to 16 flow controllers. That is what a gas box looks like that's fully populated with Pivotal Systems flow controllers, which are handling the gas flows that go into the processes that basically form semiconductors. So there's a picture of a semiconductor right there in the heart of the screen. So Pivotal provides these flow controllers, and if it's in the deposition type tool, the gases are generally used to lay down a very thin film. And if it's in the etching side of the business, we're actually, as part of a chemical process, we're etching away portions of the silicon or the resonant materials on the wafer. And ultimately you're patterning a device on a wafer that's about 400 layers deep in terms of process steps, and there's over 1 trillion transistors on a typical wafer surface. So it's highly complicated, very expensive, and the thing to keep in mind is gas flows and gas flow precision absolutely matter in the production of these devices. Let's move to the next page. This is a quick sector update. And it's important to know that in 2020, there were 19 new factories already being built. Those factories now are in the midst of being filled with process equipment, or they're coming online. In 2021, there were 19 more factories introduced into the build plan, and now in 2022, there are 10 more factories beginning construction. And beyond that, this is just a replay of the government investment that's coming from around the world. And there's various releases there, which cover the United States, the EU, what's happening in Taiwan and in China and South Korea. And so what we see is an activity where there's just a massive amount of private capital coming from very large semiconductor producers, while at the same time, there's a massive amount of capital coming from various governments. As in the last 2 or 3 years, many countries and regions have decided that semiconductor technology is absolutely important for their individual defense and their ability to provide the electronics that they need to their consumers. I think that was exacerbated by some of the various trade discussions between the US and China, and that's continued now as we see many countries beginning to have discussions about adding additional capacity beyond what individual companies have decided. Let's go to the next slide. So this is a typical sales process for Pivotal, and I'll start on the right side, because if you look there, you see the semiconductor manufacturers. These are the companies that are currently building these factories, and I've listed a few of the bigger ones, which include Samsung, TSMC out of Taiwan, Intel out of the United States, United Microelectronics Corporation out of Taiwan, SK Hynix out of Korea, Micron Technology out of the US, and SMIC, which is a Chinese-based fab that a corporation that has a multiple number of factories in China that are currently in operation and being built. The major equipment companies on the lower right side there, Applied Materials, Lam Research, Tokyo Electron, AMEC, which is Advanced Machining Equipment Company out of China, and Semes, which is a Korean etch company. Most of these companies are multi-tens of billions of dollars a year in revenue. They are absolutely providing all of the equipment that goes into these factories that are being built. Typically, we believe in the past, when I was at Applied Materials, we used about 33% of the total CapEx budget will go to equipment. So if a factory is going to cost 10 billion, as an example, companies like DE.mem, Applied Materials, and Tokyo Electron realized that about $3 billion that is going to go to them, depending on their market position and market share for equipment. And then one layer below that, you have the companies like Pivotal and our competitors, Fujifilm, Brooks, Ariba, where we provide those flow controllers to both the companies that are running and operating factories, as well as the equipment companies, Lam, Applied, Tel, and others. Typically in our industry, about 90% of all the flow controllers are sold into the equipment companies as they're producing all the new equipment going into the new factories. But about 10% of the flow controllers actually go into the device manufacturers. And what Pivotal has seen over many years is a lot of the advanced manufacturers enjoy picking up Pivotal products and putting them on tools that are known as bottlenecks. In other words, they're not able to get the amount of capacity out of those tools they need. And one of the advantages Pivotal has is that we're much, much faster than our competitors, and that enables more output. And I'll give some examples about that as we go through it. So if you move to the left side, it shows you that the flow controllers or GFCs can be specified by Samsung, TSMC, Intel, and other device manufacturers. But typically the equipment companies will qualify Pivotal and then sell them on their etch tools or their deposition tools. At this particular time, we have solid relationships with over 13 of the equipment companies that we've sold to, and now 22 of the device manufacturers. So over the last, let's say 10 years, Pivotal has worked diligently to continue to qualify new customers, both at the factory level as well as at the process equipment level. And that's enabling us to continue to drive our growth. We can go to the next slide. So why Pivotal Systems? This is a super important question because obviously we operate in a very competitive industry. And the thing that's very important in semiconductors is innovation. The entire industry is run really by something derived as Moore's Law, which was a premise set up by Gordon Moore when he was the chairman of Intel that says, basically you have to double the number of transistors on a semiconductor device every year in order to stay competitive. And what that's led to is, a typical mainframe computer in the 1980s, you can probably get the same horsepower now out of a desktop. A typical desktop computer in the 1990s, your cell phone today or your smartphone has as much computing horsepower on it or more. So we're always working, whether it's Pivotal, whether it's our competitors, whether it's the equipment companies or the semiconductor manufacturers, to innovate in order to reduce cost and get more output to enable the information age. This is the activity that allows things like the Internet of Things to be possible, electric cars to be possible. And so you'll continue to see as Pivotal goes forward, we're constantly innovating. And that's the one area where we believe it's very important for these very large multi-billion-dollar companies to understand who they should be partnering with for their next generation flow control capabilities. And we've already mentioned these flow control capabilities can impact yield and the number of semiconductor wafers out. So it's very strategic for us. And that's why we have very strong plans on and history on developing and releasing new products. And right now, we use these flow controllers and flow ratio controllers to basically stabilize the process inside factories or improve the process. And right now, our flow controllers are the fastest and the most accurate flow controllers in the world. And that includes our competitors, such as Fujifilm and Ariba, which are two large Japanese companies. One of the advantages that Pivotal has is our turn on and our turn off speed. So our standard products generally turn on and off in 50 milliseconds or less. So 50,000th of a second, we're on and providing the flow at the desired rate. Our competitors are around 500 milliseconds to 1.5 seconds in terms of their turn off times. So that's super material. If someone like Samsung is running a 20-second process for an etch, Pivotal's going to give them 19.9 seconds of manufacturing time. Our competitor is going to give them about 18.5 seconds of production time. That's about a 13% improvement in potential output. So when you're looking at this, companies like a Samsung or an Intel or a TSMC, when you build a $10 billion factory, you're really looking at your ROI and the total number of good wafers you can get out and the total number of good chips you can get out is absolutely material to their long-term plan, which is why they are very interested in qualifying Pivotal. At the same time, Pivotal's flow controllers are the most accurate flow controllers in the world. We guarantee every flow to at 0.5% of the actual flow in terms of accuracy. Our competitors guarantee 1%. So on 100 skim or standard cubic centimeter of gas flow, we'll give you 99.5 to 100.5 each and every flow. Our competitors will give you 99 to 101. So when you're doing this with, let's say, 14 different flow controllers affecting a process, the Gaussian distribution of what you'll see in terms of results on wafer has very wide tails. That is not what you want in production. You want very tight tails. You want to make sure that you're getting the best possible output out of every wafer you produce. So Pivotal gives them those advantages. Also, our competitors generally need to go down for calibration at least once a month. Pivotal flow controllers never need to be calibrated. Our innovative technology has a reservoir inside. As we flow gas, we measure how much we're flowing real time, and then we use that to calibrate our valve real time as we flow the gas. Nobody else is doing anything like that, and we continue with that type of innovation. Recently, in February at SEMICON Korea, we introduced a new software version for our standard etch products, and we're now turning on and turning off in less than 10 milliseconds. So this is a situation where it's not driven by competitors, it's driven by trying to solve tough industry problems. And when we do that, that's reinforcing the message of innovation and partnering with these large equipment and device manufacturers in order to get the Pivotal flow control solutions as the standard going forward. We actually have our AGM coming up in Sydney in 2 weeks, and we're going to be giving live demos at Molus Australia with this new software and showing less than 10 millisecond turn on, turn off times for investors that have an interest. And we'll run head to head with our competitors, which when we do this at SEMICON Korea, here in the US at SEMICON West, we generally get a pretty large crowd around that live demo. Finally, on intellectual property, we have 36 issued patents and over 389 claims. What we do is totally innovative. We measure position of our valve to the nanometer, which is 1/100th of a human hair, and we can control it now at the microsecond. Every millionth of a second, we're able to take a pressure, temperature, and position reading and adjust accordingly. There's nothing like that in the industry as far as our competitors. So we continue to try to drive forward to meet requirements based on our customers as opposed to being driven by our competitors. We can go to the next slide. So these are the growth drivers that Pivotal sees. First, our TAM is growing because the semiconductor industry is growing. Within the last week, we've gotten new reports that the wafer fabrication equipment industry is going to go from over 100 billion this year to now 107 billion. So our TAM continues to grow. Also, we're working very hard on our upgrade business. We are doing recurring revenue streams now of about $250,000 a quarter just on software upgrades. As I've mentioned, our hardware itself is very robust. We're able to change our software and then sell those software upgrades in order to get better output for our customers. So we see that business is continuing to grow. We also continue to take market share as we grow faster than our competitors. And then we're also excitingly moving into some adjacent industries. So if you visit our website or some of our press releases, in the last year, we've signed memorandums of understanding with 2 leading battery technology companies. And the reason we look at this is because we're not really required to change our core technology. We're using our existing product. One company is manufacturing equipment to do powder-coated atomic layer deposition for batteries in the lithium-ion battery space. The other one is doing something totally different, which is using electrolyte solutions to come up with next generation battery technology. In both cases, Pivotal has flow control solutions that are best in class, and that they've elected to partner with us. So we'll continue to look at opportunities in adjacent industries as we can, but our goal here is always leverage our core technology. We can go to the next slide. So here's a quick look at our 2021 highlights. Revenue was up 34%. Our margins improved dramatically as we continue to improve our manufacturing facility in Korea and get better output out of our contract manufacturer in China. Our recent release indicates we're bringing up another CM in Malaysia, and we think that's more of a risk mitigation and capacity expansion approach. New orders were up year over year 44.8%, and our backlog grew about 30%. So overall, 2021 was a solid year. We continue to make improvements towards our ultimate goal of being cash flow positive. We haven't given any guidance on that, but we're working really hard to make sure that that's in our near-term sights. Go to the next slide. And finally, we did our 4C, and at this time I pulled back on guidance because we're seeing a lot of turbulence on the front end of our processes. In 2021, most of our risk was around getting the components we need to build products. In 2022, what we're seeing is factories that these device manufacturers are building are getting pushed out or pulled in. And then the equipment companies are suffering now from not having enough of the major end items they need, like RF generators, RF matches, pumps, that's turbo pumps, roughing pumps. And so what happens is we have tools sitting in bays with our flow controllers that don't ship at the time we had hoped they'd ship because they can't take revenue until they have a complete tool. Overall, our forecast from our customers actually has gone up, but I decided that it would be cautious to make sure that until I actually have a real clear view of where we'll be in 2022, we've kind of pulled back until the end of the second quarter as we start to see things clear up. Finally, last slide. And I'd like to thank everybody. This is the contact information, and of course, Dr. Duthy's contact information as well. And you could reach me, of course, at the Pivotal Systems phone number. And that's all I have. I could open it up for questions.
Thanks, John. Yeah, one of the questions, maybe it's a bit of a quick history lesson as to how you ended up listing on the ASX. Maybe if we can just like backtrack to that point of Corp.
Sure. Yeah, in 2018, I had a board member that was on a board of an ASX listed company from the US. He believed that it would be a really good idea to consider this. As people know, I made many trips to Australia, and we decided that it actually looked actually pretty attractive to us. We went out in 2018. Unfortunately, after the industry had been in an upturn for a number of years, at the end of 2018, the industry tanked. There was just a huge pullback. And then it took us probably until the end of 2019 before the industry came back. And as we finished up 2021, we had 7 quarters consecutive quarters of growth. So we've seen it come back. And semiconductors is a cyclical industry, as people know, and that hasn't changed. And I caution people that while we're in a very robust time here in 2022, 2023, probably 2024, at a certain point in time, there's going to be overcapacity. And when that happens, you're not going to see these, at this particular time, 34 new fabs being built. It won't be like this. So this is actually an exciting time. It's very turbulent, but it's also very exciting.
A question from me, John. What does the kind of replacement upgrade cycle look for your products? So if you install a suite of these flow controllers into a new fab, how long do they last before you're getting kind of reorders for either your latest gen product, or actually we'll just take just replace the existing product like for like?
Yep. So a couple of things. One is 9 out of every 10 flow controllers that are bought are actually being bought on new equipment. So that's very important. In a $1 billion TAM, 900 million of that is new equipment going into new factories. At the same time, when we designed the product, Dr. Monkowski and I spent a lot of time trying to make sure 2 things. Number one, we used existing materials that are very common in the semiconductor industry. We didn't want to have to go through an exotic qualification process. So we used what people use, but we made sure that every component was never stressed beyond its elastomer limits. In other words, it gives it an infinite life. So our reliability issues are really around printed circuit boards, and it's typical, 10 to 15 years where thermal problems or thermal changes would affect that. So the normal life of our product is 15 to 20 years. But the products that we sell, because we look at it like an iPhone, that hardware is super robust. The piezoelectrics that we use to control it and the like, we constantly add new applications where we can tailor the flow to meet a specific customer problem, whether it's turning on slightly slower. They may want a given amount of gas the first 100 milliseconds that's greatly beyond what they want for the next 200 milliseconds. We can do that because we're able to control things so precisely with our software. So the upgrade business is not about failures. The upgrade business is about replacing competitors that just can't meet the new specs. And at the same time, there's a constant stream of these products being upgraded in our software center.
And you talked about, some of the competitors that you have, and, your product is kind of industry leading, best in class. Does that also translate into a price premium that you can charge to the customers that you deal with versus your competitors?
Yes, this is always a fine line for us around how much growth do we want versus how much profitable growth we want. And so our margins are running about, I'll say 7 points higher than our nearest Japanese competitor. They're public and they actually do break down profitability of their semi group. And so we can see that. And so, yes, we do have a pricing premium, but it's all based on value. And if it's an equipment coming out of one of the leading equipment companies, it's all about their total cost of ownership based on how much output they can get. So we can give them more output. And so even though we charge more, they're able to show that they're able to make more money based on having Pivotal. And then, of course, if it's a look at one of the large device manufacturers, yes, there's a significant premium there. They're not buying at the same volumes. So we're able to get that pricing. And of course, they're seeing direct value.
And then another question here is revenue. I think maybe slightly addressed it now, but is revenue selling the value, or is the software component, I guess, flow as a service, is that the kind of main selling point, if we can call it that?
That's a terrific question, because what we're seeing is that the hardware we provide is interesting. Let's say we have 3 circuit boards on every one of our flow controllers. Well, the computing horsepower on one of the typical process tools in this industry is like 3 Sun Spark stations back in the day. We're talking mini mainframes. They're managing thousands of variables and processes at any given time, whether it's power, et cetera. So what I think will end up is Pivotal technology can be licensed or used on one of these platforms, and it will be a software play. I think the industry is probably a few years away from that, but those type of discussions are beginning. And I think that's where these equipment company partnerships are just super material for us. And in 2019, we signed a non-recurring engineering agreement with a large Japanese firm. We collected on that. And then in 2020, we signed another one that was 5 times as large, which we just delivered that the prototype product on. I actually commented on that in the 4C time around the fact that it's meeting the process requirements. That's the beginnings of working directly with these equipment companies to provide a very brand new approach to flow control that saves everybody money and puts Pivotal more into a software business long-term.
And then, you talk about all these new fabs that are coming online. Is that part of, underlying demand, currently being very high with, I guess everybody's talked about the digital revolution, and then COVID came along and, the revolution has now happened, I guess. And, everybody's kind of wanted to upgrade at the same time, and it's led to a big backlog. Yep. But I think it's also, is it also partly to do with people have realized they need governments have realized they need their own local fabrication? Because I think I read somewhere actually produce a semiconductor. In some cases, it takes products from 40 different countries to actually come out with the final wafer.
That's spot on. So first, the age of the internet and semiconductors started well before COVID. But what COVID did is it hit a couple of tipping points, and I think we all know that you can be pretty effective working from home now with your Zoom. We Pivotal, because we were deemed an essential business, because a lot of our parts go into factories that ultimately build respirators early on. We found that our engineering teams and our sales teams are able to do their job without having to be on site. I think that's true everywhere. So what we see is now cloud computing going through the roof, the amount of data centers going through the roof. Everybody upgraded their laptop. Everybody's trying to upgrade their phone. And what we're trying to do now is leverage this advanced technology in order to do more things without having to jump in your car. And then when you do jump in your car, here in Silicon Valley, I talked about this in Australia even 2 years ago. My biggest risk when I go get a coffee in the morning is watching out for a Google car that doesn't have a driver in it, that they're test driving, right? So not only are we going, electric cars, but we're going remote electric cars, which once again drives the cloud, because all of those things have to be controlled at data centers very close to where the actual car is running, or else you'll have issues with latency, and the next thing you know, you might have somebody in a crosswalk that gets run over because the car can't react fast enough. So I think COVID's been a tipping point. I believe that the world is seeing this. You can't, frankly, in the US, you can't get a car today. The demand for cars is through the roof, and the lead time is, even from Toyota, 9 months. I was looking at a pickup truck, so I know this. So I don't think we're even close to the beginning. I think it's just starting, and all of us will get to see this as we go through our lives.
Okay. John, I know it's end of the day there for you in California, so I don't want to hold you up any longer. Thank you very much for taking the time out of your day and joining us this morning, or afternoon, your time, I should say. And yeah, we look forward to following the Pivotal System story over the course of the rest of the year. And I would say to any of the Australian-based investors, if you do want to have any follow-up questions or one-on-ones, please do reach out to Tom on the email there, or give him a call. He's based in Adelaide.
Thanks. Thank you very much.
Thanks, Sean. Thanks, everyone. And I wish everybody a good rest of their Thursday.